I debated whether or not I'd reveal my real name on this podcast. I had been looking for what that next thing was for my career. And I thought, man, this sounds like something I can do. The rest is history from there. He tweeted at one point referring to me, this guy's going to own 5 self-storage properties in a year. And so that became my goal.
Hey everyone, welcome back to the Real Estate 101 podcast. As always, I am your host. And today with me, I have the Sultan of Storage. Welcome to the show.
Thanks, Robert. Glad to be here.
Your tweets are entertaining, funny, and informative. You have a pinned tweet that says, how I bought 4 crappy self-storage properties in 14 months by listening to one podcast, sending out 50 letters, making one phone call, and paying $1,500 to talk to a stranger on the internet. All of this made you jump down the self-storage rabbit hole. Let's go through each piece of that. What was the podcast you were listening to, and why was it so inspiring to you?
Yeah, so I think it was almost exactly 2 years ago to the date. I listened to an episode of My First Million podcast with Sean and Sam, which I'm sure many of your listeners also listen to, and they interviewed Nick Huber, who at the time had built a self-storage portfolio of about $10 million. And he described the strategy of buying mom and pop storage facilities that had been undermanaged, fixing them up both physically and more so operationally, and turning them into cash flowing beasts. And I thought, yeah, at the time I wasn't sure what I wanted to do with my life. I had come out of 15 years in financial technology, and I knew I didn't want to continue to do that. And I was on a mountain bike ride when I was listening to this podcast, and I remember that moment where I was like, I can do this. I had been looking for what that next thing was for my career, and I thought, man, this sounds like something I can do. So the rest is history from there.
So not to get too personal for a second here, but was your wife or girlfriend or anybody, were they on board? Like, what was that picture like? I know sometimes that's a big barrier to not only making a career switch, but even just like getting involved in real estate. Some people have a misconception of what real estate is. And so they're really concerned if their partner or something goes into it. So I'm curious if there was any dynamic of that for you.
Yeah. So I guess rewinding to that point in my life, it was a real point of transition. I had come out of this long career in tech. We had just moved back to Colorado from London, and my wife was along for that journey, and she saw me go through so many ideas of what I wanted to do. So when I walked in the door that day and told her I wanted to start buying self-storage properties, she probably just thought, yeah, okay, that's the trick of the day. I've heard you come with many ideas. Let's I'll believe it when I see it. And luckily she's pretty understanding. She's financially very frugal. So I didn't describe for how much of our savings would have to go into this project to make it successful. But now I tell her the numbers and she's not impressed. She's far less impressed than I think most of my Twitter followers. But she lets me do it.
So you paid $1,500 for a talk. There's a lot of kind of misconceptions out there about needing mentors maybe, or paying for coaching. Like, explain to us why you spent the $1,500, if it was worth it, kind of what you learned from it, and if you'd do it again if you were going back, or maybe you're talking to somebody who's listening to the show today and they're wondering if maybe they need to pay a little bit of money to talk to an expert to kind of get their wheels turning.
Yeah, there are a lot of folks out there on the internet pushing info products, but I will say that $1,500 that I spent is the best return that I've ever generated on spend. And that was with Nick Huber. So at the time he was offering self-storage consulting. So the $1,500 got me an hour of his time to walk through a deal, help me evaluate a deal. And then he provided me a bunch of his resources that he had built, including his underwriting or financial model. And, that was worth it only because I had an actual deal in pocket that I needed help evaluating. So I got my first call back from an owner of the first property that I bought. He gave me all the information that I needed to underwrite the deal. I ran it through some models that I had built on my own, but I needed somebody else to help me look at that and make sure that it was right. So Nick walked through the model that I plugged my numbers into his model, and we had I think we had a call at 5 a.m. my time because I needed to get his opinion on this quick. And he's like, all right, if you want to talk to me, it's got to be, at 5 a.m. your time, 7 a.m. my time before my day starts. And super grateful that he got me in, again, the best $1,500 that I've ever spent. So he looked at that, and I had come in with this mentality of cutting costs. So I saw that the prior owner was running at a 45-50% expense ratio, meaning his expenses were half of his revenue. And I had read on the internet that a storage property should operate more at a 30% expense ratio. So I thought, okay, I could see the fluff. I could see he was overpaying an on-site manager. He was paying crazy amounts for things like a bookkeeper, $600 a month for a bookkeeper. That's something that I pay less than $50 a month for now. And so I had built this model to forecast all these cuts and expenses, and I hadn't really forecasted any increase in revenue. He looked at it with me. He's like, man, this deal is going to make you $1 million within 18 months. And it's not just through cutting costs, but it's also through managing revenue. The property's full today. That in itself tells you that the current owner is underpriced. He's not charging enough. And so we plugged in some pretty moderate increases to revenue along with the decreases to expenses. And voila, it said that the property would cash flow really nicely and probably be worth $1 million more than I bought it for in a fairly short period of time. And that proved to be reality. So I was able to do exactly that. I increased net income, which is the number that storage properties are used to be valued. And I've more than doubled net income in the last 21 months that I've owned that property.
Where is that property based?
It's in rural New Mexico, middle of nowhere.
How'd you end up there? Did you take that out of the Nick Huber kind of playbook? I know he's much bigger than he was now. I had him on the show a while back, but when he first came on the show, he was still relatively small. And I know he was looking at very rural areas in pretty much any state. Is that kind of how you ended up in rural New Mexico?
Yeah. For me, it was really because it's within an hour of where I live. And I drew that hour radius around where I'm seated today, and this property was within that radius. And I'm in a very rural area, and so it was on that list. Today I've continued my focus in tertiary markets. Some of my markets, I'm not even sure that you'd consider them tertiary. They're sub tertiary for a couple of reasons. One, there's not as much competition from guys like me. You don't see a lot of or even guys bigger than me. You don't see a lot of institutional buyers in those areas driving prices up. Second, for me, it's easier to understand the local market. You can pretty easily call around to the other facilities in the area, get an idea of how full everybody is, and use that data to figure out whether or not there's a balance between supply and demand, or potentially an oversupply or over demand. Oversupply being really bad if you're looking to buy a facility in the area. Over demand or undersupply being a good thing, meaning that you can drive prices higher. So I've continued to look. I've expanded outside of my little neck of the woods here, and now own facilities that are as far as 6.5 hours away from me. And I'm focused primarily on tertiary markets in the West. I don't know what's really holding me back from going outside of the sort of the Southwest region, other than there's just so many opportunities, and I got to figure out some way to focus. And today it's focusing on very specific communities in the West.
Do you go to the properties?
I've visited every property before I bought them. I have multiple properties I have not been to since closing on them. We have a remote management model, and storage is not a passive investment. It is a very active investment, particularly early on before you reach scale. But my focus with this has always been to create a business that can run without my involvement. I want to make it as I won't call it passive, but I'll make it as uninvolved as possible. And I've been lucky to have created that. So I now have a team of both remote customer service employees and a manager, along with on-site local contractors that really run the business for me, the day-to-day operations. And I think my view is that if I have to go on site to a property, something's broken in my model. Because I should have. My goal is to build this model so that I don't have to be involved.
Yeah, I don't own self-storage. Well, I own self-storage through a syndication, but I own single family homes, long distance and the remote, similar to kind of your model, but with a different asset class. And that's always my philosophy is if I have to go there, like I've never been there. I've never been to the town in my life. I've never seen the properties, nothing. So it's really remote. But I always say if I ever have to go there, then something went really, really wrong. So it sounds like you're kind of in the same boat. But the flip side of that is that you don't really have an excuse now to not go long distance. You can look all over the country now because you have the systems in place. You kind of have to just take that leap once you're ready.
Yeah, definitely. I think there is a lot of value in focus though. And that's why I've chosen to focus in specific areas, because if I start casting the net too wide, I think I lose some of that focus and become less effective. I think part of what led to that success early on was just that maniacal focus on the area around me.
Before you became today known as the Sultan of Storage, and you did everything that we've talked about so far, you were doing, like you said, business development in the fintech industry. I'm always interested, because a lot of people bash kind of the W-2, 9-to-5 world. And I personally love entrepreneurship. I love people doing their own thing, but I do think that there is some value in W-2 and 9-to-5s. And I think that there is a lot of value there. So I'm curious, what are some of the skills, the key skills that you learned doing business development in your W-2, your 9-to-5 job in the fintech world that have really helped you in buying and operating your self-storage facilities?
Yeah, it's a good question. And I'd encourage anybody who's in a W-2 today to focus on what they can get from that outside of money, because I think that I probably missed some opportunities, and like really focusing on what could I get out of that, where could I grow, how could I learn. I always wanted to quit my job from very, very early on in my career. I was focused on achieving financial independence so I could quit, and I wish that I had focused more on what I could learn and gain from that experience. But I think that I was a biz dev leader. To be successful in that role, you've got to be a great communicator. You've got to be able to tell stories and get people on board with your vision. I think that's been really helpful with storage. In most cases, I'm buying from people that are very invested in these properties. I hope that none of them follow me on Twitter and see me referring to their properties as crappy. But the reality is that, in most cases, they're older. They've had these properties in their care for decades, and they want to see them pass to somebody that's going to take care of them. And I think that I've been successful in building relationships with these sellers before they commit to selling to me. In multiple cases, I wasn't the only guy that had sent them letters, but I ended up being the guy that they sold the properties to, because I was able to connect with them, ask them questions, not just about the storage property, about themselves and their lives. And I think because of that, they realized that I was a good guy that would take good care of these properties after they sold them and convinced them to sell them to me. Outside of that, I think, I gained a general financial expertise. I understand how to read a profit and loss statement and a balance sheet, and that came in very handy. I understand basic financial metrics like return on investment, and that was that was helpful in me actually being able to plug some numbers into a model that I built to understand whether or not the numbers made sense, whether I was going to make enough money to justify the amount of work that would go into it. On the sales side, like the lack of fear, which I'm not going to say I don't have fear, but I think I developed an ability to just pick up the phone and call people over the years. And today I still have to give myself a little bit of a nudge to make phone calls. I made a couple of cold calls this morning, and you always, no matter how long you've been selling, unless you're a very special character, there's always a little bit of hesitation to call. But luckily I've built a little bit of armor over the years to be able to make those calls. And I have to tell myself, like, look, you're calling these people to offer them a giant amount of money for a property that they own. If somebody called you today wanting to buy your property, are you going to be mad about that? No, I would gladly have a conversation with anybody who called me. I have to frame it that way when I think about making these calls.
Let's unpack some of those metrics and the financial pieces that you talked about. I want to learn how you source your properties and what you're looking at when you evaluate them. I know we kind of went over that with Nick a little bit, but let's dive in a little bit deeper. So first, we know where you're investing, but tell us, how are you finding those deals, your deals specifically in that area? And then once you're analyzing, what are the big, most important metrics that you're looking at when you're deciding whether you actually want to buy it or not?
Yeah. So starting out with, how do I know if a deal is a good deal for me? I am a value add investor. I'm looking for properties that I can add value to. And that added value will result both in cash flow and appreciation in the property value. Things that shout value add to me would be an undermanaged or even mismanaged business. So in the modern world, those would be things like lack of a website, a poorly managed Google profile, not accepting electronic payments. You won't believe how many of the properties that I've bought, I've introduced card payments for the first time ever. These are cash and check only businesses. And then I look to the financials for any inefficiencies in expenses, but more importantly, comparing their pricing to the market. And so in most cases, I'm looking for properties that are below market in what they're charging, where maybe they're 50% below what their neighbor down the road is charging. So all of those factors together combine to create what I'd call a crappy storage property. The most fun that I have is going in and taking something like that is very poorly managed today and making it just a beautiful machine. Adding software, adding a website, supporting electronic payments, not only supporting but requiring electronic payments, investing in some basic marketing, implementing accounting software. It's all pretty basic stuff, but I've been surprised with how much I really enjoy remodeling businesses, which is what I do. I'm looking for businesses to fix up, and I found storage as the perfect asset class to do that. So then you asked about how I evaluate the properties or source and evaluate. So sourcing the properties, it's a very manual task today. I know there's software out there that could probably make this easier for me, but I try not to overcomplicate things. And if I start looking at software packages to make life easier, that's just, in many cases, I could just get distracted and focus more on that than actually prospecting. And so I just take a very basic approach of Google Maps to identify properties in an area, and then manually building Google Sheets. And I do use a CRM software to manage my pipeline. When it comes to evaluating the financial metrics of a property, I build a pro forma P&L, which is a fancy way of saying a forecasted P&L, where I plug in the prices that I think I could get for the units, what my expenses would be, what my cash investment would be in the business. And that then spits out sort of a 5-year profit and loss forecast that that shows me what I could expect the property to do. My number one hurdle that I'm looking for a property to hit is cash on cash return. And I'm looking for a minimum of about 20% cash on cash. In some cases, I'll get down to about 15% cash on cash return if I really like the property. But in almost every case today, I'm hitting or exceeding that return. Others look at metrics like IRR, internal rate of return. That's important if you're planning to exit. I don't have a specific plan to exit these properties. Like, I mean, I don't know why I would sell them unless I want to just completely retire, or I just really need liquidity to go buy more. But it's just amazing looking at the numbers and the pay downs of the loans and the tax treatment. All of it is just all really favorable, and I see no reason to sell anytime soon.
What size are the properties that you're buying? How many units? What's your minimum there?
They are anywhere from 10,000 square feet on the low end up to my largest properties, 40,000 square feet. Anywhere from 70 units in some of those 10,000 square foot properties up to north of like 260 units in the 40,000 square foot property. And my purchase price is anywhere from $660,000 for my cheapest property up to the most expensive one I've bought was $1.85 million.
So when you talk about that 15 to 20% cash on cash return, do you set basically a deadline for those? Because when you buy these properties, obviously, like you said, you yourself have said they're crappy properties, they're mom and pop properties. So it's going to take some time before you stabilize that asset and get it to achieve your kind of pro forma returns, your 15, 20%. How long do you give that property to get to that point?
I'm typically shooting for about 6 months to stabilize. It's in the first few months, properties may not even be servicing the debt that I've got on them, but I always want to see within 6 months a path to the cash on cash returns. And then the other metric that I look at is that debt service coverage ratio. I want to be north of 1.5x, more comfortable with like a 2x debt service coverage ratio. And I'm normally hitting that within 6 months, sometimes a little bit longer.
So if the properties aren't even covering their debt service in the first, say, 6 months, how are you funding that? Are you just going into that property with enough reserves to cover that, knowing that's going to be an issue? So you go in pretty heavy with reserves?
Yeah, and it's pretty rare that a property will negatively cash flow even early on. Typically, I'm getting a check at closing from the seller for prepaid rents that they've collected that will cover a bit. Typically you don't have a big property tax bill early on. You have a bit of time before that hits. So usually the properties are at least covering the debt early on. If they aren't, if there's months of negative cash flow, I've set aside enough reserves to cover that early on. But I would say that I'm a very conservative, like financially, I'm very conservative. I have always lived very well below my means. I've always been focused on stashing cash and building a big bucket of reserves. And I follow that same mentality when purchasing these properties and taking on debt. Like I tweeted the other day, I've accumulated $6.3 million in debt. If I told myself of 10 years ago that I had that much debt, my 10 years ago self would probably faint, as I always had this major aversion to debt. And I think that started out from an early age. My dad went bankrupt when I was 3 years old. He was a commercial real estate developer. I laugh because I'm now a commercial real estate owner. But he was, he had a very different approach than me. He was looking to get rich quick with the development of his first property. Built it in the late 80s. Market crashed in Denver where he was at the time, and he was left with debt that he couldn't pay and an office space that he couldn't rent out. Lost everything, lost his money, his family, his health. So I think from an early age, I've taken that experience to be very financially conservative and very risk averse. But I've now realized that it's not just about saving money, it's about putting that money to work for you. And you can safely leverage debt to generate outsized returns without outsized risk. And so when I'm looking at these deals, I'm making sure that the value add plan is pretty shoe in and can be done without question. And then I can get to a point where I'm not in any danger of not being able to service the debt.
Did your dad's experience and kind of what you saw with his experience make you hesitate to get into real estate? I know you said, I mean, you said you got into it a little bit later in life. You'd already been in your career for 15 years before you really jumped in. So do you think that that's what took you a while to get started?
Yeah, I think it did. I think that probably had a pretty major imprint on my mentality, whether or not I recognize that was the source. Like I said, I've always lived very well below my means. I never wanted to be in danger of losing. I would say it's been helpful in that I was able to stash a lot of cash to be able to go and buy all of these properties. But I think it also hindered me. I should be much further than where I am today. For so long, I held cash instead of putting in the markets. I mean, I had big windfalls when I was in my 20s and 30s. I'm now 40. You know, I had six figure windfalls where that cash ended up just staying as cash because I was so scared of putting it in the market and losing it. I'd seen 2008, 2009 when things crashed, and the worst thing that I could imagine was putting money into a fund or an ETF and watching it lose 40% of its value. And so for years, I just let that money sit in like, high yield savings accounts, earning whatever, like 3-5%, if that. And I've finally just realized maybe I was at a point of desperation trying to figure out what I wanted to do next with my career. But I realized that I had this capital that should have been working much harder for me all along, and I could combine that with a bit of business expertise and hard work to get off this fire train and focus on doing work that I really enjoy while making good money. And so I think I'll talk just a little bit about that. So from an early age in my career, I was always focused on fire. I wanted to gain financial independence to retire early. I remember that moment. It was probably in 2007, 2008, which is going to sound like an amazing amount of time ago for many of your younger listeners. But I remember thinking at the time, I had a high yield savings account and I was paying 5% interest. I was in Telluride, Colorado, riding my mountain bike, and I rode the lift up or the gondola up with a guy that was clearly in his 40s. It was a weekday. He was out riding his mountain bike. And I thought, man, I want that life. I want to be able to just screw off and go ride my mountain bike on a weekday without taking vacation. I built this story in my head that he just didn't work. He wasn't on vacation. He was just riding his mountain bike on a weekday. And I thought, man, if I could just get $1 million into a savings account at 5% interest, I could make $50,000 a year without any effort. And that's enough to live on. I think at the time I was probably making, $40,000 a year. And I thought, man, I just got to get to $1 million. And I had that mentality. The goalposts kept shifting. And I think eventually in like 2020, I thought, I just need $10,000 a month. I need $120,000 a year. I've got a family of 4. That should be enough to pay the bills and live a comfortable life. So I thought, okay, using that 3% rule, I've got to get to what is the number? 3% of who knows? It's $6 million.
Come on, you listen to My First Million. We don't do public math.
Yeah, we don't do public math. I gotta get my calculator out. So 120,000 divided by 0.03%. So that's $4 million. So I needed to get to $4 million to be able to safely withdraw $120,000 a year. And then I don't know what this, but I realized in 2020, I still wanted to work. I didn't want to just retire. What am I going to do? At the time I had like a 3-year-old and a 6-year-old. What am I going to do while my kids are going to school? I got to do something with my time. And so I was lucky that I found this space where I get to work. I'm really enjoying my work, and I'm making far more than the $10,000 a month and just 2 years of doing this.
I can tell you're conservative because even in that calculation, it's known usually as the 4% withdrawal rule, and you use 3%. So I can tell you're even a little bit more conservative than the general rule of thumb there. So I want to go back to your analysis. When you're analyzing a deal, what are your major red flags? Obviously, not meeting your cash on cash returns is a big red flag, but what else in the analysis is a red flag? And then also, what about the properties themselves? Is there anything specific on the properties that are just a no-go for you? It could be location, maybe something to do with the property itself. What do those red flags look like?
Yeah, I think for the financials, the value add plan has to be sure. Like it's got to be a no-brainer that I could charge higher rent and achieve those targets. If the property is already at market pricing, chances are there's not going to be a lot of room to add value. If I'm just relying on sort of an annual rent increase of 5-10%, which is probably even aggressive now in current times, I'm not going to do that deal. So it's got to be a really sure shot that I'm going to hit those metrics. Other red flags, you've got to be careful about property taxes. So I have to understand what's the impact of a sale on property taxes, because you could buy a property where their taxes are $10,000 a year today, and when it sells, it'll be reassessed. And if it then reassesses at the higher value, those property taxes could double, triple, quadruple, depending on the area. So I've got to study the local approach to appraisals and tax treatment. The other thing is looking at occupancy in the area and new supply. So this isn't necessarily part of the financial model, but I do have to look at, are there new facilities going up in the area that could dramatically increase supply and therefore sort of create an imbalance with demand? Are the other properties full or near full, or are there others that are less full that may be an indication that there's an oversupply in the market? So those are the kinds of things that are red flags. In terms of the property itself, I like to buy operationally crappy properties that are physically in good shape. I'm not interested in buying something that requires a ton of CapEx. Or investment in fixing up the property. In most cases, I'm adding a fence and gate, an automated gate. I'm adding signs, lights, but not doing a lot of really heavy physical value add. I just recognize that's not in my skill set. I'm not a developer. I'm an improver. And so I'm looking for properties that are actually like physically in pretty good shape, which in most cases, these are pretty basic metal buildings that have lasted in many cases for 30, 40 years. They're usually in okay shape.
You bought your first property not that long ago, and today you have a portfolio, I think, of about 7 properties, and you did that in give or take about 20 months or so. And not to do public math, but that's 3 months between deals or so. It's a deal every 3 months. And I mean, that's pretty quick. That's quick for, I'd say, anybody, even an experienced real estate investor. But for somebody who just jumped in, I mean, you just did your first deal not that long ago. So to do 7 in 20 months is a lot. How have you grown so quickly? And what have you experienced as kind of the pros and the cons of growing so fast?
I'm not a huge fan of setting goals, but I did actually. Nick Huber set a goal for me. He tweeted at one point before I had the Sultan of Storage profile, but I was just sort of a lurker under my own profile on Twitter. I saw that he posted after our conversation, and he said, "This guy," referring to me, "this guy's going to own 5 self-storage properties in a year." And so that became my goal, and I didn't hit it. I only got to 4, and so that was a year. That was a year from December of 2020. December 2021, I closed on my 4th property, closed on my 5th in what was it, March. So it took me a little bit longer to get there. But I kind of had that goal in my mind. But more importantly, I needed to replace my prior W-2 income, or I wanted to replace my prior W-2 income. And I knew that I had to keep going to hit my cash flow targets. So there wasn't really the option to stop. Yeah, I even today, like financially it's good. I don't need to continue to add more, but I'm really enjoying what I'm doing. I would continue to do this for the foreseeable future, even if it wasn't. Well, I don't know if I can say even if it wasn't creating financial returns. Like that's part of what I really enjoy of it. But I guess what I'm saying is that I'm already at a number that I'm comfortable with, but I'm going to keep going because I'm having fun. Things that I've learned along the way, honestly, so it's 7 today, it should be 11. There was at least 4 properties that I wish that I would have purchased. I don't spend a lot of time thinking about the past, but I passed up on some deals that I now realize I should have done. And the reason for that was lack of confidence and distraction. The lack of confidence was that, I was still early. I wasn't sure that I could execute on this playbook that the internet had given me. And so I just didn't do deals because I remember thinking, man, maybe you should slow down. Like you haven't even closed your first deal and now you're under contract on your second deal. Like, what if you close on your first and you realize that this is a business that you don't want to be in, and you've gone so far down this that you can't get out of it. So with the benefit of hindsight, I wish I would have been more aggressive early on and gone after a few more that crossed my plate. So that's a bit of a learning. And then I think the other thing too is just being aware that you always have to keep building your pipeline. I'm at a point right now I don't want to be in that it's the first time in 2 years that I don't have a property under contract. And I think I've taken my foot off the gas a little bit. There's a little bit less urgency, I think, in what I'm doing because I've sort of achieved some of my early targets. And I'll admit that I have not prospected as aggressively as I should have for the last 6 months or so. I'll give myself a little bit of an excuse in that, buying 7 properties in that shorter period of time, there's a lot of heavy lifting to do operationally and fixing them up. So I had some distractions there, but I also, the other distraction I reference is I got and quit 2 fintech jobs in the last 2 years. I was lured back to W-2 roles twice. In both cases, realized I was happier convincing mom and pop storage owners to sell their businesses to me and left those roles. But man, that cushy W-2 deposit every 2 weeks it's a hard drug to wean yourself off of.
Why not do both?
You could. I question that. I mean, I experienced it. I recognize that I was leaving a lot of opportunity on the table by staying in the W-2. So I was taking that instant gratification of the W-2 income, but it was coming at the expense of much greater value that I could have been building in storage. I mean, quite frankly, I can make more money buying storage than I could as a W-2, and I have more control. I have more control over the value of the business. Whereas with stock options, I'm subject to the performance of that business that I have a small role in.
So all of this has been done with your own capital, right?
Yep.
How do you think about potentially bringing in investors? And I'm curious because it's kind of like having a W-2 job. And people always ask me, whether I guest on other podcasts or even guests that come on here, they ask me like, what is your plan with your future real estate? And I'm like, I could scale much larger if I brought in outside money, but to me, then you have a boss again, right? You have your investors are essentially now your boss and you're reporting to those investors. And I'm like, to me personally, and I'm not 100% sure on this, but I kind of feel like I'd rather own 50, 100 units by myself, scale slowly, just own it entirely by myself. No investors, no boss, versus owning 1,000, 2,000 units with outside investors. I'm curious how you think about that.
Yeah, I often deliberate on this. The question is, do I want to own a little of a lot or a lot of a little? And the conclusion I've come to today is that I want to own a lot of a little, and that's relatively little. I don't want a job. I don't want to have to report to anybody. Today, I report to the bank who's loaned me a boatload of money. And that reporting consists of like twice a year sending them profit and loss statements that I pull from QuickBooks in a matter of seconds. If I stop paying my bills, they become a really nasty boss. But in reality, I don't have anybody that I report to, and I love that freedom. I love the fact that I've ridden my mountain bike more in the last 6 months than I had decades before that. I took a trip to the French Alps, like last minute 10-day trip to the French Alps to watch the mountain bike world championships and mountain bike with some mates over there. I couldn't do that if I had a W-2. I don't know if I could do that if I was running what is a small private equity business. And so my conclusion is today that unless I run out of capital and I have more opportunities than I have personal capital, I'm gonna keep playing with house money. I think that if I come across a big deal that I can't take down on my own, and I'm sure that there's a lot of value to be added, and I'm the guy to add that value, and I just need some additional capital, then I think I'm forced to make the decision whether or not to take outside investment. But for today, I'm really happy just investing my own money and taking the control that comes with it.
That piece you said about, I don't think I could do that if I had outside investors. I don't think you could. I mean, it depends how you design the business, how big you get, but I think that's the exact point, is that if you have investors like that, you can't do stuff like that. And maybe you make a little bit more money if you have a fund, you do a little bit of small private equity stuff, but I don't know. To me, it's just that's not the route I don't think I want to go. And it sounds like you're in the same boat there, but
I'm sure I could make more money as a GP raising outside capital. That's not the most important thing to me. That was, money was like number one for most of my career. Now it's not. Number one to me is freedom. I referenced the France trip in August. My family and I are planning to spend 6 weeks of our spring and summer next year in Europe somewhere. Like, we're trying to figure out where that's going to be. I couldn't do that if I had investors to report to. Although, maybe I could, but I would be less comfortable with that. But that's, again, as I'm building this, what is a business with a real estate component, my focus is building it to work without me. And that's with my team. Like, I've built, it's a very lean team of 3 people that manage the properties, plus, call it 7 local contractors. And I would have to, if I wanted to build this thing out and scale it using investor money, that operational team grows too. And I'm not just reporting to investors, I'm also leading a team.
As we wrap up the show, what is the biggest takeaway you want our listeners to walk away with from this episode? And where can people go to connect with you? What's your Twitter? Do you have a website, any other social media, email, anything that you want to have people connect with you with?
So the only place that you can find me today is on Twitter, at Sultan of Storage. I debated whether or not I'd reveal my real name on this podcast, but for now I'm going to stay anonymous because it allows me to be more transparent with my numbers. If you go to my Twitter profile and search terms like cheddar or bags of cash, and you'll see all the threads that I've put together on how did I stash away $1.5 million to put in of my own funds into storage. How did I finance these properties? I go in pretty deep detail there. So go to at Sultan of Storage on Twitter, where I am anonymous today, but someday I'll tell you all my real name. But I assure you, it's not as interesting as Sultan of Storage. And then advice for anyone out there. I'm 40 years old. I felt like if you would have told me when I was 25 that it took me until 40 to figure out what I really wanted to do with my life, I guess I figured it out when I was 38. I would have thought, man, that's a long time, but I'm glad he finally figured it out. So my point to, I think your listeners are probably a variety of ages, probably leaning more towards the younger age. My advice is don't wait. There is a big difference between saving and investing. And I think when you're young, you can take bigger risks with investing, but you should take calculated risks. So I'm not saying like go buy cryptocurrency risks, but more of when you're young, focus on buying cash flowing assets. Like, go buy, I think real estate is one of the best ways to grow wealth. And I would encourage your listeners to go look for real estate that you can add value to. And I think that's what I love about self-storage is it's a combination of a business and a real estate asset where you can really add value through enhancing the business while getting the tax treatment and lending availability of a real estate asset. And then I think the other point of guidance is just to keep your antennas up, looking for those opportunities that are interesting to you and learn about them. But at some point, you have to take action. And I see so many people on Twitter in my DMs asking questions that they should not be asking unless they have a deal in their pocket that they're ready to move on. Don't overthink it. Don't overcomplicate it. Just take action. And like, I'm a good example of that. If I would have sat and thought more about it, I wouldn't have typed up those 50 letters and sent them. I would have talked myself out of it, or I would have figured out a better way to do it. And I probably never would have done it. So really, in the end, just take action.
Well, Sultan of Storage, thanks so much for joining us today. I really appreciate you taking time out of your day to do so. I learned a lot, enjoyed the conversation. I had a ton more questions written down that I would love to ask and talk about. So Patrick or myself will have to invite you back here on the show soon to finish the conversation. I really appreciate you joining me.
Sounds good. Thanks, Robert. I've really enjoyed it.
I would say how you do anything is how you do everything. I know football is not going to last forever, so I wanted to make sure I had enough income coming in, use that money to live, even if football wasn't in the picture anymore. I plan on doing real estate the rest of my life. I don't have to be in a rush.